All right. Boom.
Boom.
We back.
Back to the No Bonds podcast. Ben Beck here with Matt Marizio at Beck Bodie. At Beck Bodie is our Instagram handle. You can also reach out to us at social at Beck Bodie or our personal Instagram pages at BenBeck3333.
Yep, at Matt Marizio.
Yep.
DMs all day.
DMs all day. CrossFit Open starting soon.
Oh, Lord, we starting here.
Yeah, we're starting here. I'm going to give my prediction.
All right, give it to me.
I'm going to give, it's Thursday, October 10th today.
Yep.
Tonight, Rich Froning and Scott Panchek are facing off for the 20.1 first workout of the year. Open being released tonight for them two to battle.
A couple out of shape slouches.
Yeah, exactly. They're really tall too.
Meatballs.
Yeah. It's going to be exciting. It's released tonight. I'm sure we have some CrossFitters that listen to this podcast. But here's my prediction for the first workout for the CrossFit Open this year. I think it's going to be 17 minutes long.
Yep.
Okay.
Yep.
Write it down.
I know, and I'm recording it, so I don't know why I'm writing,
so you don't have to write it down.
But I'm going to write it anyway.
It's going to be 17 minutes. It's going to include front rack lunges with dumbbells, probably 50 feet each round. It's going to include chest to bar pull-ups.
Yep.
And it's going to include double unders.
Okay.
That's you heard it here first.
Wow.
All right.
Okay, Rich.
I hope
you
it
do
does.
A good job tonight on that.
I like
Mr.
those
Froning.
movements.
All right. Well.
Yeah, on that event.
Now that we
for those of you that don't do CrossFit, have no idea what we're talking about, but that's fine.
Right. For the record, I admire people that are in shape doing CrossFit. I don't particularly do CrossFit, but the training style I do is not all that dissimilar.
No, and the foundation of what you're all about is health, fitness.
Yeah, 1,000%.
Nutrition, as is many of us here at Beck Bodie. So it's
our way of life.
Our way of life, and
probably our biggest blanket recommendation we'll make to anybody is you gotta take care of yourself. 100%. But today,
good segue. Take care of yourself physically as well as financially. Yes.
Yes.
You did it on purpose.
It's like I've done this before.
Yeah. What are we talking about? What are we talking about?
So a question I often get, and it's phrased in different ways, but really when I kind of distill it down, it's how risky should I be? And that answer can be different. Of course, that answer is different for everybody, depending on their current life scenario. But I would like to talk today about that question. Specifically, let's start with somebody who's approaching retirement. Because a lot of what we'll do is retirement planning. I think a lot of advisors plan to retirement, which is kind of an issue, and then let the rest sort of go on autopilot. Forgetting that people will continue to live maybe 25 more years after retirement, which is a long time. So, how risky? I'm going to play the role of somebody who's about 5 to 10 years from retirement. This stock market, everything I hear today is that there's an impending crash. I don't know when it's going to happen. We're at the longest bull run in history. I don't feel safe putting all of my hard-earned money into that retirement plan only to see it vanish overnight because of this giant crash. I'm nervous. What do I do, Ben?
Oh, boy. That's a tall order.
CrossFit.
Yeah.
Just do CrossFit.
Just do CrossFit. Just CrossFit. You'll be all right. Just do CrossFit. A lot of burpees, a lot of double unders. No, I mean, that word risk, let's attack that first.
Okay.
Because that means different things to different people, right? I mean, and it's an emotional word.
Oh, yeah.
How risky should I be?
Yep.
So first you got to figure out, okay, what does risk mean to you? Because sometimes, not all the time, but sometimes risk when talking about investing in general is the risk of losing all your money.
I mean,
right? I mean, you hear that.
Say, yeah.
Yeah. So, or and while that's a concern of a number of people, what we're looking at as a firm, or I think certainly is your biggest risk is not the risk of losing your money in the way many might perceive it. It's what we call longevity risk.
Okay, define that.
Sure. So longevity risk is simply put, it is the risk of running out of money before you die. And it really, in our context, it applies to how do you properly invest your money so that, especially when you get into your retirement years, it lasts long enough to support you and your family, for as long as you're on this earth. Mm-hmm. And to me, and from what we see out there, that is should be much bigger of a concern for folks that are worried about risk versus randomly, running out of money. Okay. I'm sorry, randomly losing all your money by being invested in the wrong investment and so on.
So if I'm hearing that as an investor, I'm thinking to myself, wait a minute, this guy's saying it's a greater risk for me to run out of money before I die, but isn't that literally what I'm saying? I don't want to invest in the market and then lose all my money. Mm-hmm. So explain what you mean when you're differentiating risk of the market crashing tomorrow and longevity risk, because as a potential retiree, I'm hearing those things as the same thing, and I don't get what you're telling me.
Yeah, no, good question. So when somebody's looking at their portfolio and they're worried about risk, you agree with me probably. Any portfolio that you've come across, as what we do, as an independent firm, we review a lot of portfolios from folks that aren't clients necessarily. Most aren't. And we take a look at how people are invested, and they come to us from all different backgrounds and perspectives and so on. But risk is certainly something that comes up in terms of how risky should I be, and am I going to, am I putting myself at too much risk? And oftentimes, what we're seeing,
meaning, is there too much potential I'm going to lose all my money?
Correct.
Yeah.
Correct. And you use the market crashes tomorrow. Looking at your statement, and your money is going to be lower tomorrow than it is today, obviously. So but what we're saying is that, and this again, this does not apply to everybody, but for most folks that we've come across, their risk, even if they're invested not optimally right now, their biggest risk is not the effects of what a market crash can do to their portfolio in the near term. Again, we've got to affix this to certain personas, right? In terms of you use the example of somebody maybe 5 or 10 years from retirement that this is a legitimate concern for because they don't want to run out of money, or they don't want to lose money, which in effect is running out of money as well. And what I'm saying is that the effects of market events like a correction or like a market crash that typically don't last for a long period of time is a much less risk than what they are currently doing. And what we currently see is that they are not investing properly in order to prevent themselves from running out of money. In other words, they are investing in securities, in types of investments that have a fixed rate of return or a very conservative expected rate of return.
Okay.
And
I don't want to lose my money, so I'm hearing you. That sounds safe.
That sounds safe.
I like this.
But what is not often considered is what is safe looking today. What does that mean for 10 or 15 years from now?
Means I don't run out of money, Ben, so I'm safe.
You're safe, but each year we have this pesky thing called inflation, where the price of goods and services, really anything in our lives, on average, historically, increases at about a 3% clip, plus or minus. I think it's a little lower right now in terms of the CPI and such. But let me give you an example. I love pizza. You like pizza?
I love pizza.
I love pizza.
I
So
can
one of my
eat a bowl of
favorite pizza places growing up in South Portland, Maine, Holler, Sopo, is this place still around called Pizza Joint, the Pizza Joint.
Okay.
And
Shout out the Pizza Joint.
So shout out to Pizza Joint. I don't know if they have an Instagram handle, but we'll learn that before. We'll
wait to
tag it in the Instagram.
Yeah, I can't wait to get some of their pie.
Yeah. And it's one of those cool places too. I remember as a kid, they used to make the Italian style pizza right in front of you. So you used to throw the dough up in the air. You'd watch the entire process. You know, a little different than Chipotle. That's not interesting to me. But throwing a pizza up in the air and throwing the sauce on there and loading it with pepperoni, that's where my head's at, right? More often than not. So I remember growing up, I think I was probably in middle school. We used to get pizza all the time, and the price of a medium cheese pizza was $7, and I think it was $7.15. Today, that same pizza is $16 and change.
Ooh, bless.
Okay?
Wow.
So I just actually looked it up the other day randomly. I don't know what drove me to that. I was hungry for pizza, apparently.
Make a quick trip to South
But yeah,
Portland.
that's right. But my point is that if you do the math on that, that's actually a little bit more. That's a little bit more than it's about a 4.5% rate of inflation over those last just about 20 years.
Wow, that's awesome. Not only did you check out the price of pizza there, but then you went ahead and figured out, well, how much is that inflated by?
Yeah, right. But it's important because you think about what you spend your money on. I mean, food is a big.
Yeah, but you got to eat.
Food.
Even in retirement, you still got to eat food and drink water.
You have a water bill. You have electricity bill.
Yep.
You have all of these costs, heat, everything, that over time, it's a tough argument to make that those costs are going to go down. They're going to go up. They go up every single day. We've talked at length about how many kids we have, and adding children to the family. That adds cost to your household,
which will add grandchildren potentially closer to retirement. Which
you
want to spoil as a grandparent.
So my main idea, is bringing up the whole thing about pizza because I love pizza. But you could look back at if you had the opportunity to, or if you just remember what something cost in the past. A common analogy is what a car cost in 1970 versus what a similar car costs today is one that I hear often. But think about things in your own life. If you remember what something costs X amount of years ago, and you know what it costs today. Pull out your handy dandy financial calculator and find out what type of compounded interest rate that appreciated by on average year over year. That's your inflation rate. So to expect that won't continue into the future, and then especially for that, again, going back to that persona that you just mentioned in terms of somebody 5 to 10 years away from retirement, and once retirement happens, that means your regular sources of income are shut off, right, from employment, and now you're focusing on, or you're using what you've saved, in terms of retirement and such, but also Social Security, and you've got to be very, very cognizant of not only how much money you have, but what that is growing by even at that point, to make sure that at minimum that keeps up with the rate of inflation. So that risk, again, going back, longevity risk it has nothing to do really with short-term market events, because the market is always going to be in flux.
Got it.
But
what you are saying, those things that I felt really good and felt really safe with, that are paying me that same fixed rate for the next decade, which really appeases my emotions. You're saying that I can't go to get that pizza at the same price in 10 years, but I'm still getting the same salary.
Relatively the same salary.
Right, with very little growth on that.
So you might be downgrading to not a medium but a small at that point.
Do they sell
a 12-inch. Medium's 14-inch.
Huh.
I haven't been there in quite a while.
Dang. But I'm a hungry guy.
Yeah,
that won't change.
I'm starting to get hungry right now.
Man, okay, so I get it. So longevity risk. Let's rewind the hands of time here and use one more persona just for the sake of this conversation. And let's say that you are somebody earlier in your professional career, but not somebody brand new. I want to use the example of somebody who's not a first-time entrepreneur, right? Because we've talked about this. Our recommendation to somebody who's in the initial stages of building a business, that is their future, that is the best rate of return they could possibly ever see, is reinvesting in themselves.
So you're talking about the entrepreneur,
So
the
I'm
business
talking about
owner.
a business owner,
Right.
but I'm not talking about the one that's brand new, starting their very first one. Let's say if they actually are, for some reason, either a previous career or a previous event in their life, maybe they sold a previous business, maybe they inherited some money. Let's say they have money in the bank and they aren't quite sure what to do with, because as an entrepreneur, you always feel like you can grow this thing. So you always feel like I should always reinvest in myself. I should take everything I have, dump it back into me. How risky should I be with stuff that I'm not putting back into my business? Should I put everything back into my business, or should there be stuff outside? And with that out, let's say that the answer is yes, you should have some outside. Should I be less risky with that? Because here I am dumping it into me. How risky should I be there?
So we're talking about a younger investor, not young, but younger than the previous, person that was emerging retirement, that was a few years away from retirement. And we're also talking about a person that has some savings built up in some way, shape, or form, owns another business or works at a different company. Maybe they have some old 401ks lying around they haven't done anything with, and they're trying to figure out, okay, at this point in my life now, how risky should I be? And you're saying that they've already determined that at least a portion of this money is not going to be poured back into my business from a business owner, but it's I got to do something with it. And how risky should I be with that money?
Yeah, what should I do?
Yeah, which I think the old the fact that we always use the word runway. How much runway, meaning time. How much time do we have? So for that portion of money that you have set aside and you've acknowledged that I have to do something with this, not going back into my business, and I'm trying to figure out what kind of risk I should take with this money. The first thing you look at, okay, is how much time do I have before I'm going to use this money? And then, what are your objectives in terms of, do I want to grow this substantially? Do I want to see this a lot higher in the future? And obviously anybody's going to say yes to that. Depending on how much time you have, and we always use at least 5 years before, but for most folks, they have horizons a lot longer than that. We do feel that you should take a significant amount of risk with that money. Now, again, I got to be careful with saying the word significant, right? Because just like the word risk, it means different things to different people. But certainly, putting your money at risk, where it does have the potential for short-term losses. So in other words, it does fluctuate. But the risk versus reward equation is the reward side of that, given the amount of risk you're taking, is highly in your favor down the road. And that's the big thing that we look at, is that, and time is a big function of that. If you have 1 year or 2 years before you're going to be able to, you're going to need to use that money, that really shortens in our opinion, shortens the options that you have. If you have a longer runway, you're a professional, you are working, you own a business, so you're employed, and you have a certain amount of money, you want to take, and you have a good enough amount of time, you want to take some risk with those funds, because the reward at the other end, despite what type of market environment we're in right now, or ones that we may, or let's say will go through, you get 10, 15, 20 years before you're going to access this money. It makes sense to take in my opinion, a significant amount of risk with that, because the reward will be there.
Even though emotionally, so what I'm hearing, and I think there are some topics that we can blanket recommend, right? So beginning with the end in mind is what I heard with that when you talked about a time horizon. It's also what I heard when we talked about that pre-retiree. You have to know where you're going and how long it's going to take to get there first. Otherwise, it's really difficult to create a roadmap to an unknown destination. So I hear that, and that's a pretty common recommendation. I also heard you talk about the emotional aspect of that risk, and it sounds like, and you and I both know this, but emotions and investing really don't play well together in the sandbox.
Mm-mm.
So
Not at all.
it would be on us, let's say we'll put the onus on you too, as a listener, as an investor, but also as someone you hired to help you with your finances. It's on them to help you identify whether or not your emotions are getting in your own way.
Right.
Right?
Yeah, I think to take an example of what obviously we feel really strongly about and how we run our practice here is that it's our responsibility to make a recommendation first and foremost based upon us putting ourselves in your shoes, right? In not considering, as funny as that sounds, not considering somebody's emotions first.
Yeah.
So one popular guy nowadays on Instagram and former Navy SEAL David Goggins comes to mind.
Yep.
Just a fantastic story. Can't
Hurt Me.
Can't Hurt Me. Read the book. Can't Hurt Me. Great book about his upbringing, very difficult upbringing, and his path through the armed forces and all the challenges that he had. And one of the things that he commonly talks about is the duty that we all have with either family members or friends of, in so many words, calling them out.
Yeah.
And not being worried if they're doing something that is wrong or detrimental to their health or their well-being, whether it's being overweight or doing things that just aren't don't represent the type of people that they are.
Yeah.
It's our responsibility as a family member or friend, if we're a true friend, to call them out and be direct and not worry about how they might react to that. And we take the same approach with how we work with clients in that I'm going to make a recommendation to every one of my clients or a prospective client, not worried about how they feel necessarily towards risk. Now, let me qualify that because at the end of the day, it ends up being a mix of our could be or not a recommendation if they don't become clients of ours, right? But the intent of that is not to be a dictator or a one-way street. The intent of that is to create a dialogue that follows that so that we come to a better understanding of where they're coming from, and you have a better understanding of how things work or how emotions, as you put, can get in your way.
Right. Because
oftentimes, let's use a quick example. If let's just say the market, right now is in a really tough spot, and we're, it's every newspaper article you read is about how the market's crashing and so on and so forth, and which is pretty normal for whenever the market's going through a correction.
Oh man, drama sells, right? School bus arrives safely.
Doesn't sell any papers.
Yeah, you don't see that one on the headlines.
And so very difficult emotionally during those times for individual investors to purposely put money into the stock market, right?
Yeah.
Because let me go out for a walk when the sky's falling.
Yeah, right.
But we all know, if we get our emotions in check, we all know that that's usually the best times to invest in when the market's not doing well, because you're, on a very simplistic basis, you're buying companies at much lower prices than you would. But when are most people comfortable with investing in the market? When things are going well.
Yep.
It doesn't necessarily mean that's a bad time to invest either, but the best time to invest is when the market's not doing well. So we know we are all human beings, obviously, and we are driven by, and a lot of times, our emotions. And our job as advisors are, first and foremost, to remove emotion from the equation and provide recommendations that are going to put you in the future in the best possible position. Have that create the dialogue and that educational process. Okay, what does that actually mean? And so on and so forth, and then coming to something that is reasonable.
Right. Then overlay what the numbers say versus how you feel, and let's come up with
And then you figure out whether you're willing to take that amount of risk.
Yeah.
Getting back to what we're actually talking about here is that after that dialogue and after that coming to understanding about what that actually means, I think just through talking it out and being educated, you come to a greater understanding of what first of all risk means, and more importantly, what risk means to you. And
Yeah.
I think that can answer a lot of questions.
I love that. That's a good way to wrap it up. So we're
Yeah.
going to never begin without an end in mind. The end can change, but it's really difficult to create any plan without
Right.
an end goal and
Right.
destination. Try to navigate without emotion first. And watch the CrossFit Open. I think that's what we covered.
Yes, yes.
That's
yes.
perfect. No,
Yeah.
I will say that if you guys have heard something that you resonates with you, or you know somebody that's at a similar life stage as the couple personas we've talked about, please share it. Our whole reason for this is what Ben just said, is that we are creating this so people feel confident in the financial decisions they're making with their lives, right? Because we can educate them on some of these topics.
Yeah.
So if you like it, share it. Follow us on Instagram. Send us an email,
Yeah.
social@BeckBodie, if there are specific topics or suggestions that you have for us. We're both former athletes, and we have thick skin. So if you have criticism, so long as it's constructive, we'll listen, and we'll listen to that too.
Yeah, yeah, and I'll wrap it up by saying, this investing stuff doesn't have to be, but it's often a foreign language for a lot of folks, and I blame. A lot of the blame, I think, goes on the industry for this, because there's so much noise out there in terms of how you should invest, how you should not invest. And we're here, obviously, to give our opinions on things, too, because we feel very strongly, and that's how we run our personal lives, and that's how we run our professional lives. But what Matt said, reach out with questions and comments, criticisms, what have you.
Yeah.
The purpose of this is a educational process.
That's awesome.
That's
Thanks.
awesome.
All right.
We can cover.
Yeah. Anyway, anybody that
Yeah. What do you got there?
anybody that is watching saw a note get hand delivered to me. Very
nice.
So if you're listening and you're not watching, there was just a note hand delivered to me. Very important stuff.
Awesome.
So that's
You're very
our call to
important
wrap this
dude.
thing up.
All right.
Yeah. Well, thanks for listening.
Thanks for listening.